Hello, welcome to the Chapter 8 problem solving session. Let's get started with our first exercise. Exercise BE 8-1, the direct write-off method. So we have to account for this receivable that needs to be written off. So we have a situation where they've only received $325 from the $500 that was owed. So on the 17th, let's write that off and recognize that we have an uncollectible account using the direct write-off method. So remember the direct write-off method. So on March 17th, the direct write-off method means we're going to recognize what we're able to receive here, which is some cash. All we're getting is $325. And what we also have to recognize here is that we need to write off $500. Because the total amount of the receivable is the $825, but they're only getting $325 and they have to write off the 500. So the direct write-off method says when you determine that you have an amount that's uncollectible, you write it off. So bad debt expense. Bad debt expense for $500. And now we've got to remove that account receivable. $325. And that's a write-off. That's a write-off of that account receivable using the direct write-off method. But then what happens is, they receive better information. And now July 29th rolls around and they're actually able to collect some of the cash. So we're going to reinstate and show the collection of cash. So now on July 29th, what's happening here is we're able to determine that we will be able to collect some of the cash. So we're going to reinstate this account receivable. So account receivable for $500. And we're going to reverse it out of bad debt expense. And now we've got the cash. So we're going to, on the same date, debit that cash account for the 500 and credit accounts receivable for the collection. And that's the direct write-off method. So we directly write off the receivable when we know it's uncollectible, right? Debit the bad debt expense, record any cash that we are able to recover, remove the receivable. And then if at some point we determine that we will be able to collect on it, we reinstate the receivable, show the collection on account. That's the direct write-off method. Let's talk about the allowance method now. So now in this situation, we're going to write off an account, same account, right? Same situation. We're only able to collect on 325 of an $825 debt, but we're using the allowance method, not the direct write-off method. So again, March 17th. On March 17th, what we want to do is recognize that we're getting some cash. How much? Well, we're getting $325. Let's show the collection on the $325. We are writing off $500. It's the allowance method. That means that we have an allowance account. So that $500 write-off is going to go against that account. And we've got to remove the receivable from our books. That's the direct write-off method. And then again, down the road now, we're able to determine that the customer will be able to pay something. So we want to reinstate that account receivable on July 29th. So on July 29th, we're going to put that account back on our books. For $500. And we're going to go back to that allowance account and reverse it. And then we show the collection, right? We recover the cash. So debit the cash account for the 500 and remove that receivable again. And that's a write-off using the allowance method. A write-off using the allowance method. Okay, now let's look at the percent of sales method. So let's continue with the allowance method, but now we're going to add to that the percent of sales method. Remember that there are two approaches we could use to estimating those uncollectible accounts when we use the allowance method. We could either use the percent of sales method or we could use the analysis of receivables method. In our next exercise, exercise BE 8-3, I think I went too far here. In BE 8-3, we're going to use the percent of sales method. So what we need to be able to do here in A is determine the amount of the adjusting entry. And then B, we need the balances in the accounts. And then C, the net realizable value. So let's start by determining the amount that we would need for the adjusting entry. So the bad debt expense. When we use the percent of sales method, it's the bad debt expense is really pretty simple. It's just a percent of sales. And in this case, it's 1/4 of 1% of sales. 1/4 of 1% of sales. So 1/4 of 1% of sales. And what does that equal? Well, a quarter is 0.25. And 1%, 0.01. And the sales are given, they're 5,125,000. Or I'm sorry, sales are 105,550,000. So all these numbers are given. Let me make sure I highlight those. So the sales are here. That's 105,550. And the percent of sales is 1/4 of 1%. So we estimate here that our uncollectible accounts, if we do the math here, 0.25 times 0.01 times 105,550 gives us 263,875. 263,875. That's the amount of our adjusting entry. So they didn't actually ask us to do an adjusting entry, but you know what? I'm going to do one anyway, just so that we have that as a point of reference. So if we were doing the adjusting entry, the adjusting entry would be a debit to bad debt expense. For 263,875 and a credit to the allowance for doubtful accounts. Two six three 875. That's what the adjusting entry would look like. So under the percent of sales method, the adjusting entry is based on whatever we get from this calculation. This is the most important calculation because this determines our adjusting entry. So that's A. And now we need the adjusted balances in our accounts. B, we need to know what the balances are in our accounts. And I'm going to set up a few T accounts because I think it would be easier if we actually had T accounts that we were working with. So let's see, right here, we need accounts receivable. Then we need an allowance for doubtful accounts. And then we need a bad debt expense. Those are the three accounts that we're asked about, right? We need to know the balance in the accounts receivable, allowance for doubtful accounts, and the bad debt expense account. So let's label these accounts, these T accounts that I've set up. This is accounts receivable. And this is the allowance for doubtful accounts. And this is the bad debt expense. So we have those accounts. And let's see, what do we know about those accounts? Well, accounts receivable has a balance of 5,125,000. That's an asset. Assets normally have debit balances. So accounts receivable has this balance of 5. That's the accounts receivable balance. The allowance for doubtful accounts has a debit balance. So the balance here is 32,600. And when we post this adjusting entry, so the reason why I'm doing the adjusting entry, even though they didn't ask for it, is because it helps in terms of understanding the T accounts. When we post this adjusting entry now, after A, right, we would be debiting. So the adjusting entry is a debit for 263,875 and a credit to the allowance account for 263,875. And so in part B now, the balances in these accounts, well, the accounts receivable account balance is the 5125. But these other accounts, well, we need to net these transactions, right? So net these two transactions so that we determine what the balance is in that account. So the allowance for doubtful accounts, if we have a debit for 32,600 and a credit to the allowance for doubtful accounts, then what we want to do is offset those, right? That 263,875 minus 32,600 gives us 231,275. 231,275. 231,275. So this number here, 231,275. That's the balance in that account. So the answer to part B, the adjusted account balances, accounts receivable is still 5,125,000. Allowance for doubtful accounts is 231,275. Bad debt expenses 263,875. And what's the net realizable value of the accounts receivable? What are we going to have in that account? Well, in part C, I got a little bit of room down here. In part C, what we would have here, what you would see on the balance sheet in the current asset section, you would see something like this. You'd see accounts receivable. And the accounts receivable would have the 5,125,000, and it would be minus the 231, minus the 231,275. Which would give you 4,893. Let me put that here. Let me just scroll down here. So less I'm just going to abbreviate that, allowance for doubtful accounts, less the 231 275 gives us the net realizable value. That's the accounts receivable, and it's net, accounts receivable net balance. So the net balance of the accounts receivable is the 4,893,725. So again, what we're obligated to do is to report those receivables at the net amount that we actually expect to be able to recover, right? We only expect to be able to recover 4,893,725, not, not 5,125. So that's what we want to be able to report on, the net realizable value of the accounts receivable. Okay, that's the percent of sales method. Let's take a look at the analysis of receivables method next. So the alternative, if we don't use the percent of sales method, then when we're using the allowance method, we would use the analysis of receivables method. So in this case, we need to know the amount of the adjusting entry, and then we need to know the balances in the accounts and the net realizable values. So same thing we just did, only it's a different method. Now for this method, what we need to do is start out with those T accounts. So I'm going to set up the T accounts because we need to know right off the bat, right, what those T accounts look like. So we're going to need that accounts receivable. We're going to need the allowance account. And we're going to need the bad debt expense account. So let's see, this is the accounts receivable. This is the allowance for doubtful accounts. And this is the bad debt expense. Okay, and what do we know? Well, accounts receivable has a balance. Asset account normally has a debit balance. Accounts receivable has a balance of 5,125,000. Allowance for doubtful accounts has a debit balance of 32,600,000. And the sales are 105 million. That's all we need for now. And the aging method is used. So when they use the aging method, they determine that the balance of the allowance for doubtful accounts should be $225,000. This is key. This is the key number that we need now to move forward. The allowance for doubtful accounts should have a balance of 225 because that's our estimate of uncollectible accounts. So what we're saying here is that this account, the allowance for doubtful accounts, should have a balance of $225,000. That's what the balance needs to be in that account, balance after adjustment. After we adjust this account, we're going to need a balance of $225,000. Well, how are we going to get that? How are we going to get a balance of $225,000? Well, the only way we're going to get from a debit balance of 32,600 to a balance of 225 is by adjusting the account for this amount. It's going to be the 32,600, right? And we're going to have to add in that $225,000, and that will give us the amount of the adjusting entry we need, 257,600. That's the amount of our adjustment. That equals the adjustment of 2576. So now, again, if we were asked to prepare an adjusting entry, and I'm going to do it anyway, okay, an adjusting entry, then we would be debiting the bad debt expense. We'd be debiting it for 257.6. And we'd be crediting the allowance for doubtful accounts for 257.6. Because now when we post this, right? So the adjustment here, by debiting bad debt expense for 2576 and crediting the allowance account for 2576. Now, when we balance this account, right? The balance in this account, right? This debit offsets this credit such that the balance now in the account is 225, right? 2576 minus 326 gives us 225. So the amount of the adjusting entry is the 2576. That's A, right? The amount of the adjusting entry is the 2576, right? It's what's in the account, and we got to add to that account, right? When we add the 257.6, then the net of these two gives us what we need, a balance after adjustment of exactly 225,000. So the amount of the adjusting entries here, 257.6, that's A, and the balances in these accounts. This is the receivables balance, this is the allowance account balance, and this is the bad debts account balance. And again, the net realizable value of our accounts receivable. Well, part C, the net realizable value. So again, we've got accounts receivable. Which is a balance of 5. And the allowance for doubtful accounts is the 225. $4.9 million is the net realizable value of the accounts receivable at the end of the period after all adjustments. We've seen the allowance method using the percent of sales and using the analysis of receivables. So again, if I could emphasize what happens with the percent of sales method is our adjusting entry is just based on the percent of sales, right? We just use the percent of sales to determine the adjusting entry. But when we use the analysis of receivables method, the adjusting entry is based on what we need to manipulate this allowance account to get it to what we think the estimate should be for the uncollectible accounts. Okay, let's switch gears now and talk about notes receivable. In exercise 8.5, we're going to look at the notes receivable. And what we need to do here is determine the due date of the note, the maturity value, and then the journal entry to record collection of the note. The customer actually pays the note. So the due date of the note, let's work on A down here. So the due date of the note, all right? So the note is dated, it's issued April 12th. And let's see, so how many days is that? So April has 30 days, right? So April has 30 days and it's issued on the 12th. So 30 minus 12 means we actually have 18 days in April. And then let's see, what do we have in May? May has 31 days, right? So May has 31 days. And then June has only 30 days. June has 30 days. And then July, well, July is 31 days. So where are we so far? How many days do we have? Because we need, this note is a 120-day note, so we need 120 days. So let's see, 18 plus 31 plus 30 plus 31 is only 110 days. We're not done yet. We still need another 10 days. So August would be another 10 days. Now we're done. So now add this column. And what do we get? 18 plus 31 plus 30 plus 31 plus 10 is 120 days. So when is this note due? What is the due date of this note? The due date of this note is August 10th. That's our due date, a due date of August 10th, because 18 plus 31 plus 30 plus 31 plus 10 is 120 days. So that's our due date. Our due date, in order to get from April 12th to 120 days in the future, we got to go all the way to August 10th. So A is our due date of August 10th. And the maturity value. Well, the maturity value, let's see, the maturity value, which is going to be part B. The maturity value equals the face amount plus interest. And what is interest equal? And it's actually it's well, let's see the so the face amount plus interest, and what is interest? Well, the interest, let me see if I can get some brackets here. Interest is the face amount times the interest rate times the term. That's how we get the interest. So let's see. Let's fill in some numbers here. The face amount of this note, how much is the face amount? It's $500,000, 6% interest, 120 days. So we got 500,000 plus 500,000 times 6% times it's a 120-day note. 120 days out of 360 days. And let's put that in bracket. That's our interest. So what do we have here? We have here 500,000 plus $10,000, which is that's our maturity value, $510,000. And now we need an entry to record receipt of this note. So the note matures on August 10th, right? On August 10th. So on August 10th here, we're going to be collecting the maturity value. What's the maturity value? $510,000. We just calculated it. We're going to be collecting the maturity value. And we want to make sure that we remove the note, the face amount. We have a note on our books that we need to remove, a $500,000 note. And we've got to recognize that we've earned some interest. $10,000 of interest. Okay, that's it. So we determine the date, August 10th in Part A. We determine the maturity value, $510,000 in Part B. And Part C here is the actual recovery of the cash proceeds for the note. And we're done here. Okay, so that's what we did on my notebook. Let's go back and take a look at our accounts receivable again. Let's look at some uncollectible accounts and exercises 8.3 and 8.4. So now in these exercises, we're not going to worry about the sale of the merchandise. So I'm not going to cover this transaction on January 19th. All I care about is the write-off and the recovery. So with that in mind, we have on June 2nd, they've received only $400 on this sale, this $5,000 sale. So we need to account for the bad debt on June 2nd. On June 2nd, uh, we're only getting $400. Customers are only able to pay $400. And so we got to write off $4,600. And it's the direct write-off method, right? This problem is the direct write-off method. They use the direct write-off method. So that means we just go immediately to bad debt expense, right? And we write off this uncollectible account. And we got to make sure we remove that account. All $5,000 of that sale needs to be removed. And as luck would have it, they're able to recover something. So on October 23rd, now it turns out that the customer is going to be able to pay in full. So we got to reinstate that account receivable. So we've got to reverse what we did. So let's put the account back on our books. Put that $4,600 account back on our books and reverse that bad debt. And then actually collect that cash or collection of cash. So it's kind of like what we did several problems ago. One of those first couple of problems we worked on using the direct write-off method. Write off the account, right? And it goes directly against the bad debt expense, right? So they've only collected $400, remove the expense, recognize the expense, and remove the liability, and then reinstate it when we're able to recover something. Put the receivable back on the books and reverse that bad debt expense, and then show the collection of the cash. That's the direct write-off. Now, on the other hand, when we are using the allowance method, and again, I want us to focus on the receivables transactions. Let's not worry about the sale here. Let's only focus on the receivables transaction. On September 30th, they're only able to collect 10,000 of this $27,250 receivable. So on September 30th, they're only able to collect 10,000. And they're going to write off the rest of it, right? The other the account was 27,250. They're only collecting 10. So the other 17,250, they're not able to collect on. We need to write that off using the allowance method, right? They're using the allowance method for uncollectible accounts. So that means we write off against the allowance for doubtful accounts. And of course, we remove that account receivable for 27,250. And again, now what happens is on December 7th, now we find out that the customer is going to be in a position to pay. So we want to reinstate that account receivable. So we're going to debit account receivable for the 17,250 and go back and put the funds in the allowance account. 17,250. And show the collection now. We're going to collect on that account receivable. We've got the cash. Debit cash for 17,250. And credit account receivable. Remove that account receivable. We've seen, again, accounting for these uncollectible accounts using the direct write-off method and using the allowance method. Now, let's look at the same transaction two different ways, right? They're going to write off this account. There's no recovery, no reinstatement. We're just going to write it off. We're going to write it off using the direct write-off method, write it off using the allowance method. So in part A, they've got a receivable for 15,220, direct write-off method. Let's write it off. That means that we're going to go directly to that bad debt expense account. That's what we do under the direct write-off method. But under the allowance method, right? We don't do that. Under the allowance method, we've already recognized an expense, right? In an adjusting entry, we recognize the expense. Now all we do is we charge off uncollectible accounts to the allowance account. So two options, right? If the company's using the direct write-off method, if it's a small company, they don't have a lot of accounts receivable, that's fine, they can do this. But for those larger companies that have a large amount of accounts receivable, they can't do that. They can't use the direct write-off method. They which means they're going to be doing something like this. Okay. Next, we've got one more of these accounts receivable problems. So let's take a look at that. We're going to again look at both methods, direct write-off and the allowance method. So we've got some accounts, right? All four of these accounts have been determined as uncollectible. $30,000 worth of accounts are uncollectible. So if we use the direct write-off method in part A, we need a journal entry to write off these accounts. So let's see. Let me just identify this as A. In A, we're going to use the direct write-off method. That means we go directly to bad debt expense. for that $30,000. And of course, we remove the account receivable for the $30,000. But when we use the allowance method, well, we don't recognize an expense. We just charge it off against the allowance account. So in Part B, what we want to do now is we want to write off against the allowance for doubtful accounts. That's where that $30,000 goes now. And of course, we credit accounts receivable for the $30,000. And also, there's one more thing that they ask us to do here in Part B. We need the adjusting entry. They are using the percent of sales method, and we need an adjusting entry for the end of the year. And the adjustment is going to be based on past history and industry averages, 0.75% of the credit sales. 0.75% of the credit sales is determined to be uncollectible. Well, so we need to know how much that is. So if it's 0.75%, so the adjustment, the adjusting entry amount is based on 0.75% of the sales, which are 5,250,000. So that means that we need 0.75%. 0.75 is 0.75. 0.75 is 0.75 times the 5 million, right? And we want to convert that percentage to a decimal. Move it 2 decimal places to the left. Move your decimal 2 places to the left. So when we do that, we end up with 0.0075 now times the 5,250,000. And what's that equal? Well, that equals 39,375. That's the amount of our adjusting entry. Okay, so the adjusting entry amount is the 39,375. So our adjusting entry, right? When we adjust here, we're going to be debiting that bad debt expense for the 39,375 and crediting the allowance account, allowance for doubtful accounts. And there we are. We can compare the direct write-off method for writing off uncollectible accounts, $30,000 worth of uncollectible accounts in Part A, with the allowance method, the percent of sales allowance method. We write off $30,000 worth of accounts, and then we actually make our end of year adjusting entry based on 0.75% of our sales. 0.75%, 0.75 is 0.75. Convert that percent to a decimal, move the decimal 2 places to the left, 0.0075 times the 5,250,000. Okay. And the last one is a note receivable problem. So one more time at calculating the due date, maturity value, and then the journal entry for receipt of payment. Exercise 820. So let's see. Part A. Maturity value or the maturity date. Maturity date. Let's see. We're starting here. Issued. So our starting point is This note was issued on April 10th, right? And let's see, April has 30 days in it. So 30 minus 10 means we've got 20 days in April. And then we have May, right? May is 31 days. And then we have June. June is 30 days. And then we have July. July is 31 days. And how many do we have so far? Let's see. It's a 120-day note, and we've got 20 plus 31 plus 30 plus 31. That's 112. It's 112, and we need 120. So 120 minus 112, we need another 8 days. We need 8 days in August. So August of 8 days, that will give us our total of 120 days. So we now know that the note is issued on April 10th, and 120 days after that puts us on August 8th. That is the due date of the note, August 8th. And the maturity value. So the maturity value of this note equals the face amount plus the interest. And the, let's see, the interest, how do we get that? Interest is a function of the face amount times the interest rate times the term. So let's fill in some numbers here. The face amount of this note is $60,000. 6% interest, 120 days. So 60,000 plus the 60,000 times the 6% interest times the term, 120 divided by 360. So we have here 60,000 plus $1,200 of interest, or 61,120. 61,200. That is the maturity value of the note. The maturity value of the note, 61,200. And then if we want to record the collection of that note, so all we need here is on what date? On August 8th. On August 8th. On August 8th, we want to show the collection of that maturity value, 61.2. And we want to recognize now that this note's been collected. This $60,000 note has been collected. And we've earned some interest. There we go. And that's it. Hopefully, this has been helpful to you and it will assist you in completing your application assignment and your quiz. See you in our next chapter, chapter 9.